Hello, everyone. Many thanks for joining us, and welcome to CGAP's webinar, Navigating the Next Wave of Blended Finance for Financial Inclusion. Prior to get started, I will walk you through a few logistical matters in order to make sure that we take advantage of the webinar. This is an audio broadcast webinar. Attendees' microphones will remain muted for the entire webinar. We welcome everyone's participation through questions and comments, and for doing that, we ask you to please use the chat box on the right-hand side of the WebEx session. Please submit your question or comment at any time during the webinar. You do not need to wait until the Q&A session for doing so. To ensure your question is seen by the moderator, please select all participants from the drop-down menu when sending your question or comment. We will be recording this webinar and we will be emailing it to all attendees and registrants along with the presentation. We're very pleased to be joined by some experts in the field of blended finance. Joan Larrea, CEO of Convergence, my colleague Barbara Scola from CGAP, Milena Bertram from Finance in Motion, and Henry Gonzalez from CGAP as well. I will walk you through the agenda that we will be covering for the next 60 minutes. Joan will provide us with an overview and setting the scene of the state of blended finance, mostly based on some of the recent findings of the 2018 report on blended finance. My colleague Barbara will bring CGAP's practice and lessons learned in regards to blended finance in financial inclusion. We will then move to Milena, who will provide us with a case study from Finance in Motion that will illustrate how blended finance is put in practice. And then I will be ending the presentation with a few reflections on what is now being called Blended Finance 2.0 and some of the areas where CGAP hopes to start doing some research, and hopefully other like-minded institutions will be doing so. And then we will be opening it for Q&A. I will remind you again that the question and answer should be done throughout the session, and you can send them as people speak or as your comments or questions come to mind. Thank you very much, and with further ado, I will now pass the microphone to Joan Larrea from Convergence.
Thank you very much. This is Joan Larrea from Convergence. I'm going to walk you through essentially first, what is blended finance and where is it happening more broadly, and then take you through the field of financial inclusion in specific. So very briefly, what is Convergence? We are the global network for blended finance. We generate data on the subject as well as content on the subject and deal flow in the blended finance community. We also have a grant window by which we hopefully are putting out new additional concepts that should feature in the landscape of blended finance. Okay, blended finance writ large. First of all, what is blended finance? Let's get a definition going here. Before that, why blended finance? The obvious, we have an enormous amount of work to do to achieve the Sustainable Development Goals. A lot of money needs to be directed toward them, and the private sector has to be part of the solution. So blended finance is any structure where you are using catalytic capital from public sources or philanthropic institutions to draw in private sector commercial capital into a transaction in an emerging market. That's as straightforward as we can make it. We at Convergence think there ought to be 3 hallmark signatures of any blended finance transaction. First, it ought to be generating a positive financial return overall. Second, it ought to be contributing in some way toward the Sustainable Development Goals, even if not every single participant in the structure cares about or even knows about the Sustainable Development Goals. And third, the money coming from the public or philanthropic side is in fact serving to draw in private sector money. So we have a database of about $130 billion worth of business that is closed out there in the marketplace in blended structures. It represents over 2,800 commitments by over 1,000 parties in about 395 transactions. So we think this is still a really conservative estimate of the scale of what's happening out there. It's just what we can point to data point by data point. So blended finance is not small is the first point you should be taking away. Where is it happening? It is happening very prominently in sub-Saharan Africa. Almost half of the transactions we have recorded that have closed have been there. The next most frequent place where you'll see a blended finance transaction is in Latin America. And about half of the countries targeted in blended finance deals are lower middle income, and only about a quarter are happening in the least developed countries. By sector, let's look. By sector, you'll notice that there's a preponderance of deal activity happening in financial services, which is the subject for today, as well as energy and non-energy infrastructure. And I will leave that there because I want to get further into the financial inclusion slides. All right, so financial inclusion very specifically. So still looking at our database, what are we seeing? We see about a quarter of the transactions by deal count. This is not by value. About a quarter of the transactions we have captured address financial inclusion. Either it's the full objective of the transaction or it's a large part of the transaction's goals. You'll notice that these deals are primarily in the financial services sector as well as in the ag sector, for example, in value ag financing, smallholder financing, or crop insurance. There are a small number of deals happening in the education sector, for example, in increasing access to student loans. There's also a significant number of transactions happening in the pay-as-you-go energy field. In terms of what do these deals look like as structures, you'll notice that relative to the entire data set that Convergence has for all blended finance solutions for financial inclusions are more likely to be in funds and in companies and less likely to be in projects or facilities. Blended companies focused on financial inclusion have had the largest average deal size, which we think reflects a number of large microfinance institutions and finance companies that have raised capital through blended structures. Target regions. As compared with the larger data set we have, we see that Latin America is receiving more funding in blended finance structures for financial inclusion than, like I said, than the overall data set. It's 32% of the financial inclusion deals in our data set as opposed to 17% of overall blended finance activity happening there. You see blended finance solutions for financial inclusion tending to target multiple regions. That is, these bars add up to far more than 100% overall. And that is reflecting the strong use of microfinance funds, which tend to diversify, they have diversified strategies that cross multiple regions. All right, there are stereotypical types of financial inclusion structures, blended finance structures. We see the same deal styles happening over and over again, and so we've diagrammed them out, and this slide shows you some of the more frequent shapes of deals. I want to first look at the margins of this slide, the very left and the very right columns. And we've looked at the data for financial inclusion specifically and asked the question, what structures are showing up in this field? So looking at the very left-hand side of this slide, you'll see that blended finance often involves concessional debt or equity in the permanent financial capital stack of a firm or of a microfinance institution, for example. So 46% of the deals that we have captured in financial inclusion have this element. That is, there is some kind of concessional money in the permanent capital structure of the transaction. Looking at the right-hand side, we also see that almost half of the transactions in this space are using technical assistance funds. That is, some kind of facility sitting alongside the permanent capital structure in order to strengthen the transaction and thereby reduce some of the risk and entice the private sector in. What we don't see very much is in the middle of this graph or the middle of this slide, guarantees or risk insurance being offered by concessional parties to strengthen the transactions. We see it happening about 14% of the time versus 28% of the time in our larger data set. Similarly, we are not seeing a lot of early stage concessional capital coming in to test out and prove structure that could later on be invested in by more commercial parties. All right, let's talk about who the investors are in blended finance for financial inclusion. Just a reminder, we are not saying that everybody on this slide is providing concessional capital. What we are saying is that they are present in transactions that have concessional capital and therefore are blended. So for example, IFC typically is not doing concessional, they're trying to price at market. So going from left to right, you see that the development agencies, of course, feature prominently. And the interesting thing in the financial inclusion space is that we see multi-donor funds and multi-donor initiatives popping up more frequently relative to our larger database. So you'll see the Multilateral Investment Fund of the Inter-American Development Bank, AECF, which is the African Enterprise Challenge Fund, and Global Environment Facility, which is focused on climate. The philanthropic sectors, philanthropic investors here make sense. Omidjar Network, Oiko Credit Acción will be, of course, familiar to all of you who live in this space. The multilaterals mimic the larger data set. IFC, FMO, and EIB are all major players in blended finance, regardless of sector or intent. And on the right-hand side, among the private investors, you'll notice it's a pretty even spread among both traditional commercial investors and impact-driven investors. There are some interesting names that pop up in financial inclusion that do not feature prominently in our larger data set. So for example, TIAA, VDK Bank, and Storebrand. They're showing up in this field, but not in the larger blended finance statistics that we have as prominently. Okay, where to for blended finance? First of all, I think you can agree with us that blended finance has entered the mainstream. We're seeing very articulate, meaningful, positive commentary on the subject from pretty prominent institutions such as the United Nations, the OECD, the G7, the donors, the DFIs, and the multilateral development banks. That said, there's still a lot of healthy skepticism. Among the issues being asked are, to what degree does blended finance reflect national ownership of the development agenda? How effective is aid when it is placed into structures alongside commercial capital? And these are really important questions, and they deserve further attention. Blended finance is not a cure-all. It's not going to potentially make every SDG investable or eradicate poverty all on its own, but it does have a lot to offer the field. And we at Convergence think that it is time for a blended finance vision. We think that there should be a shift from fragmented activity to a set of common goals that everybody's working toward. We think that those solutions that have the potential to scale should be doubled down on, and we think that everybody ought to be increasing the amount of knowledge and data sharing in the community. So that's that, and I will now attempt to pass the microphone on to Barbara Scola. Give me just a moment to relearn how this works. The screen has shifted a bit from what I was familiar with in the test run, so maybe one of you can step forward and help me. Barbara, I am not seeing the handover baton that I would like to see.
Now I see myself, so it should be fine.
Great, thank you all.
Much, Joan. Thank you so much, Joan. And yeah, let me just, yes, I have it. I have control over the slides, so everything's fine. And I hope everybody can hear me. And dear participants, please don't forget to type your questions into the chat window as they pop up. This was a very rich presentation by Joan. Thank you so much. And I'm sure there are a lot of questions already with regards to the data and the points that were shared. So I will take it over from here and hope to share a good dose of optimism, but also some of healthy skepticism, as you said, Joan, on what I think is the role of blended finance in financial inclusion. A lot of what I will be sharing today is based on CGAP's work over the last 2 years or so that I've been leading together with Luis Moretto and my colleagues here at CGAP. So looking at the state of blended finance, we have seen that financial services already play a big role in blended finance. So over the next 10 minutes, we will ask the question, well, how important is blended finance for financial inclusion? We are going to look at the role of private investments in financial inclusion. We're going to talk about some of the opportunities that we see in financial inclusion for blended finance, and discuss what we think is important for blended finance to lead to results and be effective in this sector. First of all, on this slide, we see how total cross-border funding for financial inclusion has evolved over the years. The bars here represent total commitment from all active projects or investments at a certain point in time. So it's not annual flows, it's the total stock of funding available for financial inclusion from different funding sources. This global estimate is based on data from the CGAP Funder Survey and also the Symbiotics MIV survey. Let me highlight 3 things here. Total commitments to financial inclusion continue to grow, and they have now reached over $40 billion. Second, private investors, here represented in blue, represent an important funding source for financial inclusion. And third, the share of private investments has been around 25% of total commitments for the last couple of years, meaning that overall, public and private funding is growing at about the same rate. So we have not seen a major shift towards private funding. What do we take from this? Financial inclusion continues to represent growth opportunities for private investors. We see the total amount of private investments going into financial inclusion grow. But at the same time, there still seems to be a need for public funding to address challenges in financial inclusion. That can be either because some of those challenges just cannot be solved by investments, but also there might be some areas where that just don't yet generate returns that attract private investors. And that's where blended finance obviously has a role to play. Let's take a closer look now just at investments in microfinance and how it has evolved over the years. The main mechanism for channeling investments to microfinance are the so-called specialized microfinance investment vehicles, or MIVs. Today, there are over 110 MIVs managing assets of almost $16 billion in total. Looking back more than 10 years, in 2006, the total assets under management were just about $2 billion. So what started really as an experiment has developed into a real industry over the course of 10 years. So there is really something to learn from the MIV experience for the broader blended finance space, as MIVs really have proven to be an effective mechanism to attract private investments at scale. So where do MIVs get their funding today? Private institutional investors, such as pension funds, insurance companies, foundations, etc., represent the main funding source for MIVs today, around 55%. Another 27% comes from private retail investors and high net worth individuals. Today, public funders, mostly development finance institutions, represent only 18% of total MIV funding. 10 years ago, this picture would have looked very differently. If we look at the evolution of the funding sources of MIVs over time, we see that in the early days, public funders were major investors. But from the start, the majority of MIVs aimed at raising funds from private investors. And even if that wasn't really called blended finance at the time, Blended finance mechanisms were used either to set up the investment vehicles or later on at the fund level to mitigate the risks for private investors. And that really seems to have worked, as we see on this slide. Over time, MIVs started attracting institutional investors and retail and high net worth individuals. These new investors, in particular institutional investors, became the main providers of funding for MIVs, and their investments are growing at the highest rate. Interestingly, the symbiotic survey shows that the highest growth was recorded by funds that actually blend public and private capital, as opposed to funds that only have private or public funding sources. So we see that the MIV model is an effective model for channeling private investments, in this case to financial inclusion. So are there lessons that the broader blended finance community can learn from the MIV experience? We would like to highlight a few of those lessons that we think are relevant. First of all, transparency matters. The development of standardized financial and social performance indicators, benchmarks, joint definitions, and also annual surveys that track how the industry developed were very crucial in building the credibility of microfinance as an investment class among private investors. Second, infrastructure matters. Many support functions were needed to help the MIV industry reach scale. For example, market information, fund labeling, currency hedging, etc., etc. Many of those functions were funded or are still funded by public funders, and some of them, for example, the TCX currency hedging facility, benefit from blended finance. Third, scale matters. MIVs have proven to be a very effective mechanism to attract private investments at scale. And it's interesting to note that today, more than half of total assets under management are managed by the top 10 MIVs. Fourth, crowding in matters. In theory, public funding is supposed to pave the way for private investors. In practice, this is sometimes more complicated. For public investors to really play a catalytic role, they need to have a clear and realistic exit strategy from the start. And they should be held accountable for that as well. Last but not least, diversification matters. Going forward, many MIVs are looking to diversify their portfolio across regions, but also they're moving into new sectors and new asset classes. As we've seen also on Joan's slide, where we already see other types of themes emerging in the financial inclusion investments. While this seems like a crucial strategy for future growth for MIVs, it also raises questions about whether the very specialized MIV business model will be fit for diversification and is adapted for a more diversified investment strategy, or whether we will see the MIV business model evolve as diversification goes on. So where do we see the opportunities for blended finance in the financial inclusion space? Today, many microfinance institutions have access to a broad range of funding sources, both international and local, to finance their growth. Private investors are investing through MIVs are increasingly comfortable with microfinance investments. So there is not such a need anymore for blended finance for conventional investments in microfinance institutions. Funders that want to use blended finance in financial inclusion should therefore focus on areas where private investors are not yet comfortable investing and where there is a real promise in terms of impact and scale. Those are typically business models in an early growth phase where risks are still significant. We see three categories of business models where blended finance really has a role to play in financial inclusion. Those are, for example, tech-enabled business models, digital financial services, and fintechs, where we do see a lot of private investment already, but where there is a big concentration in some markets and some star companies and many others that lack access to funding. We also see an opportunity in business models that link financial services with other essential services such as energy, education, and water. And third, we see an opportunity for blended finance to advance access to finance for farmers and for agribusinesses. I'm not going to go into much more detail on those three areas, but I invite you to have a look at the CGAP paper that is also called Navigating the Next Wave of Blended Finance in Financial Inclusion, where you will find a little bit more about those three areas. So last, to close my presentation, I would like to share some considerations that we think are important to make sure that public funding sources are used effectively and in line with their development mandate, and so that we can make sure that blended finance is not only leading to more funding, but also to better results. First, the focus should be on addressing the real barriers that discourage private investors. Sometimes those can be addressed with blended finance mechanisms. But barriers that often hold back private investors, such as political instability, weak regulatory environments, etc., cannot be solved through investments alone and still require public funding. Second, donors and DFIs should leverage existing funds and facilities and not rush to set up their own. One lesson from the MIV experience is that scale matters and that private fund managers tend to do a better job at managing assets, so public funders should leverage those competencies. Third, DFIs often face difficulties investing in newer and riskier business models. So for DFIs to be truly catalytic, maybe their incentive structures need to be adapted so that they can take more risks and be more innovative. Fourth, in blended finance, a lot of the focus is today on leveraging foreign private investments, as Joan already mentioned. Donors and DFIs should not forget to build reliable local capital markets that will help crowd in local investments from private sources. Then, another point is that private investors and DFIs are still largely lending in hard currency, about 70% of total lending, and there is definitely still more effort needed to mitigate foreign exchange risks. As we've seen in microfinance, building the market infrastructure is extremely important to build investor confidence. Private investors have been attracted to microfinance also because transparency on financial and social performance significantly enabled them to identify well-performing MFIs and has helped build their confidence. So to crowd in private capital, whether it is in fintechs, pay-go businesses, or other new business models, we need robust and comparable data on their financial and social performance. And public funders have a role to play to help build that market infrastructure. Last but not least, there is a role for public investors to help promote and implement responsible investment standards. In the microfinance industry, there are well-established consumer protection and responsible investment standards, and they're applied on a broad scale today. As new business models emerge and also a more diverse range of players start serving the low-income segments, donors and DFIs should help encourage responsible practices also by these new types of businesses. So maybe as a short conclusion of this presentation, we think that there is definitely a lot to learn from the microfinance experience for the next wave of blended finance. So with that, I would like to hand it over to Milena Bertram from Finance in Motion to give us an example of blended finance in practice. So let me hand it over to you, Milena. You should have control now.
Hello? Yes, this seems to be working. Let me switch to the next slide, which unfortunately, now it's working. Okay, good. First of all, for those who do not know Finance in Motion, let me give you a very brief introduction to the company. It's we are managing some of the MIVs that Barbara referred to earlier. So we are a global impact asset manager focused exclusively on sustainable development in low and middle income countries. And we've come from managing only MIVs to now also looking at different subject matters in the green finance space. We're headquartered in Frankfurt, but have a very strong regional presence with around 17 offices worldwide. And all the funds that we develop and advise are funds that have a blended finance component. In particular, we bring together public and private investors. We've seen that philanthropic capital does not yet play such a strong role, and that is the same in our case. Since our foundation in 2009, we have facilitated almost 600 investments and have unleashed around 4 billion in total. We currently have around 2 billion assets under management. And geographically, we focus on Southeast Europe, the Caucasus, Latin America, the Middle East, and North Africa. In total, we have made investments in around 30 countries. This gives you a very brief overview of the funds that we currently advise. Two of them are microfinance vehicles, the EFSA and SANAT on the right-hand side of the slide. But as I mentioned earlier, we also address green subject matters. While microfinance is largely covered by EFSA and SANAT, of course, green activities may also be financed by MFIs via the other two funds. How do these funds work in practice? We pool different types of funding from donors, development finance institutions, and private institutional investors in Luxembourg registered funds who provide dedicated financing to local partner institutions, banks, microfinance institutions, leasing companies in the relevant target countries, and then on lend to the end beneficiary, which can be small businesses, households, farmers, SMEs. In addition, the fund in selected cases, and that depends on the fund, can also provide direct investments. So we also engage in project and corporate finance and have equity participations. All the funds have a technical assistance facility component that, again, I think was highlighted earlier by Joan, who can provide technical assistance, capacity building support to either the partner institutions, so the MFI, or not to a large extent, but selectively also to the end beneficiary. Why do we set up blended finance vehicles? These are just a few of maybe the check boxes you want to tick. And one of them certainly being that the asset and or the geographic area require catalytic capital. And I'll speak later a bit about the SANAT fund in particular. That is a fund that operates in Middle East and North Africa, often perceived as a very risky region. So there literally the public component gives private investors the guarantee, or at least the perceived guarantee that they're shielded from credit risk. The blended finance structure may also help to kick off the fund, which was the case most recently when we set up Arboro. That has nothing to do with microfinance though. It may also address market failures. Long-term funding is often not available, for instance, for microfinance institutions. And via these vehicles with donors providing perpetual capital even or very long-term financing, this can be pooled with rather short-term funding from private investors, and we are still able to on-lend long-term funding to microfinance institutions. We also believe it's a very efficient use of public resources. For instance, because we are able to pool different sources of public funding. This is an excellent means of coordination, especially for the smaller national development banks from smaller countries. It also facilitates innovative instruments and ultimately increases the outreach and the impact. And that is something I want to discuss a bit more in detail on the next slide. How do we address the issue of foreign currency versus local currency lending for microfinance institutions? Most local finance borrowers, the micro enterprise, the small enterprise, do not have the capacity to bear foreign currency risk. But most local financial institutions have limited capacity to convert currencies. So if you lend to them in US dollar, they will mostly on-lend in US dollar as well. So local currency lending from the MFI to the end borrower can only be promoted in large scale by providing also funding in local currency to the microfinance institutions. But then the fund would bear the foreign currency risk, which is something that most investors were not looking for. Theoretically, FX risks can be hedged, and this is something we try to do with derivatives. For instance, we're a very active client also of TCX, or by issuing debt in a local currency. But the investments enabled by these available hedging options have not been enough. So what do? You want to give local currency to the microfinance institutions. Investors don't want to take the risk, and hedging is not sufficiently available. So 5 years ago, this share class, what we called L shares, for local currency shares, was introduced into the capital structure of Sonat and funded by the German government. This is a dedicated share class aimed to enable local currency lending by absorbing the net results of currency movement only. For this risk, this share class is rewarded with an interest rate differential, which is set by an expert committee based on sound macroeconomic and financial analysis and local expertise. And this interest rate differential is aimed to reflect the currency risk. The other shares and notes, including those provided by private investors, take the credit risk of all those loans, but the currency risk remains with the L shares, which allows us to provide unhedged local currency loans to microfinance institutions and allowing that partner institution to on-lend in local currency without incurring themselves unreasonable risk. That's what we try to portray with this umbrella. So partner institutions are shielded and eventually also the micro, small, and medium enterprises. For us, this is a very scalable and complementary solution, which can really enable local currency lending, because hedging quotes are very volatile usually. So we still give priority to hedged loans, but use L shares as a fallback when other options are not available. It also allows us that we could, for instance, disperse initially unhedged and then hedge if quotes come down later on. We can accumulate an unhedged portfolio in a certain currency and then issue a bond in local currency later on to cover it. All these are certainly advantages that shall not be forgotten. It also complements existing hedging options in the market. So still cooperating with solutions like TCX is very important. This, overall for us is also an impact solution. Providing local currency is at the core of what microfinance industry today needs to look at. With that, I end here, and if there are questions later on as to the setup of this particular structure, then I'm happy to answer.
Thank you very much, Milena. And thank you, Barbara, and also Joan. As it has been stated, blended finance is benefiting from a great momentum as a conduit to achieve sustainable development goals. Financial inclusion has been using blended structures for the past decades, and it can surely shed light on the next wave of blended finance. And Finance in Motion through Milena represented an opportunity where blended finance is addressing local market and financial sector development. Indeed, a welcome change for the microfinance industry and for the next wave of how we want to look into this. CGAP has been reflecting on how to contribute to what Joan labeled blended finance 2.0. CGAP's influence model aims to scale impact, and we engage with members, industry bodies, donors, and investors to produce research that allows adaptation and replication at scale. And under this background is that we want to engage in this research agenda of blended finance 2.0. We carried out a recent literature review on blended finance, and we realized and confirmed that the lessons and experience of financial inclusion, specifically microfinance, was not as present, or it was rather diluted at best. The large focus of blended finance has been mostly on investment vehicles or investment structures. Very little has been on enabling environments or building infrastructure for market development. The majority of the transactions reported are focused on capital flows, mainly coming from the global north. Very little has been on local investors and local markets or local currency. Lastly, there's been quite an alignment that SDGs are being used as the proxy for impact and accountability on blended finance, but financial inclusion is not an SDG in itself, it's an enabler and a conduit to several SDGs, and therefore it's important that we could contribute in the conversation regarding SDGs. Now, this reflections or gaps encountered provide an opportunity for CGAP and other institutions to deepen how the financial inclusion could further the research agenda. And we are going to focus on 4 areas. One is to look at how financial inclusion could scale new sectors, new business models, and innovation. How we can look into capital, mostly local private capital and local market sector development, and also the importance of blended finance to work on investment readiness, technical expertise, and operational capacity, which was already mentioned, that has to do a lot with TA, which seems to be where half the resources is going. However, it is important that this also goes into the enabling environment and the ecosystem at large. Lastly, there is a lot of room, as we have already mentioned, and Barbara deepened into some of the areas and the reasons why, that we should make the lessons of financial inclusion more relevant, more visible to the broader discussion on blended finance and what the rest of the new sectors could learn from. We're going to be working on these topics, and we hope to engage with several stakeholders to contribute with big tasks of building this industry and hopefully moving the trillions needed to meet the SDGs. We're still exploring. This is an early stage, and any feedback on where we can take our agenda is rather welcome. And we hope to also partner with some of the institutions that are currently participating in this webinar. With this as our core presentation of the webinar, we will be proceeding now to the questions and answers. And we have already received a few, but still welcome our colleagues to send comments and questions using the chat box on the right. And please remember to send to all participants to ensure that we are all able to see your questions. Prior to passing on the first question, I'd like to take this opportunity to thank Joan, Barbara, and Milena for their participation and dedication. And we hope this is just the beginning of further conversations on this very important topic. Thank you very much. Joan, perhaps I would address the first questions to you. It's a question in regards to conservation finance and where does conservation finance fit into the blended finance ecosystem, especially conservation finance in North America. The participant mentioned that the figure of blended finance in North America is rather small, and he was wondering whether the topic of conservation finance is outside its scope, and he was giving an example of the Lime Timber Corporation in the U.S. I'll pass to you so you can provide the answer to that question.
Thank you, Jan. I know the Lime Timber transaction. Sorry, there's a bit of an echo. Thank you. So the very brief answer to the question is simply that Convergence does not capture any data in North America. We are focused primarily on the emerging markets, the developing countries in the world. However, conservation finance is a big deal in the blended finance community. There's an awful lot of work happening, both in North America off our map, as well as in the developing countries that we do keep track of. So some of the big players are Conservation International, the Nature Conservancy's NatureVest group, the World Wildlife Fund. There are a lot of fund managers in the conservation space. So it's actually it's a really active area for blended finance. We just do not capture anything in North America.
Thank you, Joan. The next question is regarding how do we ensure that public funding does not distort market or crowd out truly commercial capital? I think this question is at the heart of the conversation. Let me just maybe give a bit of a reflection and then happy to hear from Milena or Joan or Barbara you would like to add. I think this is at the core. And as Barbara mentioned, we need to somehow keep DFIs accountable for what they need to do. However, I do see a few recent developments that could also provide some hope into that. One of them is actually CDC, the UK DFI. CDC has decided to engage in a higher risk investment strategy in which they would like to go into sectors that require more patient capital, and they are okay, and their board has approved that they are okay in having a lower overall portfolio return on their investments. I think, as you can see with this example, it requires a governance alignment. It also requires the actual technical knowledge and technical expertise. In earlier conversations that I had, they might be working into a lot of the areas of health or access to medicines or low-cost medicines. So there are some of those sectors, but indeed there has to be transparency and also alignment on governance on how to avoid this. That is a welcoming example. Having said this, there is a lot of anecdotal and some, I would say, studies evidence that sometimes there's been crowding out. There were some dialogues in the financial inclusion around those conversations, but there seems to be a few developments that are at least in the right direction. I don't know whether someone else would like to address some of this crowding in, crowding out.
Maybe to add to this, I think at least we would argue that our funds act on a commercial basis and are not crowding out. But what public funding is also facilitating is that the perceived risk is covered, because I see that often private investors would not go into those markets all by themselves, simply because they lack a lot of the information. They cannot assess the market as well as we may be able to do it. And that's something that these funds can cater for. So we truly believe that the pricing that these funds offer are mostly reflecting the true risk return, or the true risk. For instance, the SANAD has not made any losses, so the public funding that is made available serves as a cushion, as a guarantee, but it has not been touched so far. That shows you a little bit how actually low the risk is, but as it is perceived as being high by the investors, they would probably want to charge a much higher rate if they went in by themselves.
Thank you, Milena. And perhaps we can stay. I'm sorry, Joan, did you say something?
I was going to ask if it's okay to pile on, or do you want to move to the next
Yes,
question?
please go ahead. It's a very important question. Go ahead.
Yeah, it really, really is. So I think that where you see first of all, grants always distort. Grants distort whether they are handed to somebody directly or go through a financial vehicle. So let's just remember that and take it very seriously. I think where you have a crowding out, an accidental crowding out of legitimate, full bore private sector unmixed activity, it's because of a misdiagnosis on the way in of the problem. I think it is incumbent on those who are offering concessional capital and blended finance structures to think about off-ramps and to think about ways to do price discovery to figure out what the true willingness of the private sector to come in really was. You heard Finance in Motion talking about L shares and doing macroeconomic analysis before structuring those. That's really important. But there always should be an off-ramp. If you are going to put concessional money into a structure in its first round, are you planning to do it again, or are you planning to prove the thesis and then walk away, hopefully? I do think guarantees are a really nice means of putting information out in the market. That is, if you have a concessional player guaranteeing some difference between the perceived risk and the real risk, and that guarantee is never called, then that information is out there in the market and can be used to do the next transaction without the concessional player trying to purchase some of the risk. So I think there are ways to make sure that good practice emerges. And I just want to make those points. Thanks, Henry.
No, thank you so much. I'm going to be making two questions right now, one for Milena and one for Joan, in the interest of time. Milena, there's a question in regards to the management of your TA facilities. Could you provide some details around how they are managed, and if they're managed by yourself or a separate manager, and what governance structures that are in place to ensure there's coordination between the investment and the TA activities? While you have a thought of that, let me just send a new one for Joan so she can start chewing on it in order to make sure that we take the time. Joan, there's a question in regards to the issue of information for de-risking private capital. Would public subsidy for information infrastructure be better served than subsidy at the fund level? This is about data or about, some of that. Is it better to work on the infrastructure and then have a public good for several, or is it better to work at the fund level? I'll pass it on to Milena to answer the TA question, and we'll come back to you, Joan. Thank you.
Very quickly on the TA facility is managed by Finance in Motion as well. We have different people, different teams working on it, although in close cooperation, because naturally, if you do a due diligence on a microfinance institution, you will figure out what their shortcomings or weaknesses are and where you want to work together to improve those. So, but on structuring then the actual project, that requires, again, different, I think, also capacities and skill set from the people working on it. What we don't do, we don't implement the TA ourselves. So we very much outsource to external consultants, because the topics that we then cover are so diverse that we could impossibly cover all of that in-house. That may be technical skills, language skills, etc., that are needed that we cannot provide for. Also, I think there's a certain conflict of interest that we want to avoid. But what I think is important in this context to highlight, because we were talking about grants, a certain amount of the funding is provided to the microfinance institution as a grant, but they all have to chip in around 30%, I believe, in cash. that is not an in-country contribution, but a cash contribution to ensure that there is sufficient buy-in. And in our largest microfinance fund, actually that grant funding is not anymore coming from additional public donor money, but to a very large extent, this is the TA facility is funded by profits that are retained and not paid out to the investors, but that flow into the TA facility.
Thank you, Milena. Joan, would you address the question of public subsidy versus subsidy at the fund level?
Right. The question was whether it's better to subsidize information infrastructure or actual transactions. The people who thought up Convergence, and I was not present at the formation, settled on both are important because we were, and this is the World Economic Forum, the Government of Canada, Gates Foundation, Rockefeller Foundation, USAID. They all felt that putting more information out there, at least about blended finance, was critical, as well as seeing transactions happen. So I don't know how to rank them. I would say that information is always king. Where information is clear, the market will respond adequately in most cases. But there are many, many cases in which nobody's ever done a transaction in a country. There are no pricing signals. What do you do in those situations? Blended finance is a bridge between where we are now and where we would like to be. It is not a permanent solution. And I think the value of blended finance transactions is that they spin out information about what the real risk of a transaction was versus the perceived risk on the way in. But blended, so both are important. I think transactions do have an important role to play in putting down markers for the market. And I would urge anybody who is operating on the philanthropic or concessional side of the ledger in any blended finance transaction always to be thinking ahead to the information you can share about that deal in hindsight. One of the things we do is write case studies on specific deals. It's hard to get data on what happened in a transaction, and the private sector has no motivation to share it. It is up to those who are spending public money or philanthropic resources to push information out, and I would just make a plea for that. But both are important, information infrastructure as well as actual deal flow.
Maybe I'd like to just add a point to that and totally agree that on the importance of information infrastructure and the role that public donors also can play to help build that infrastructure. I think what's important to keep in mind is also that when we help develop that infrastructure, that we also have a longer term vision in mind and think about an infrastructure that really matches the needs of the market and that is sustainable in the long run. Because we have seen in the microfinance experience that, maybe in the early days, it is very attractive for donors to invest in building the market infrastructure. But what happens after 10 years, after 15 years, and transitioning from something that is entirely donor funded to something that is more commercially viable has proven to be very complicated. So there needs to be a longer term strategy from the get-go.
Thank you, Barbara. There was a clarification requested. MSME, the acronym, and MSME stand for micro, small, and medium enterprises, which is sort of the broader segment that we talk when we speak about financial inclusion. Well, as we are close to the 1 hour session, I would like to first thank everyone again for their contributions. We invite you all to stay active in these conversations, to stay tuned on CGAP's Convergence, Financing Motion, and other industry players' research on this topic and the broader financial inclusion. Enjoy the rest of your day, and thank you very much. And we look forward to hopefully having other webinars. And thanks for being very active with the questions. And we hope this was also useful for your activities. Good afternoon or good morning, wherever you may be.